You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome back to our content coming at you from the Options Industry Conference 2024 here in scenic, or at least so they tell me, Asheville, North Carolina. I'm here in this room for you listeners. I don't get to see the sun, but we get a great group of people coming throughout the week to talk to me and indeed to you about all the hot button issues hitting the world of options these days. And next up in the hot seat is a newcomer to the program and indeed to the network. She is Meaghan Dugan, the head of options over there at NYSE. Meaghan, welcome to the Options Insider Radio Network.
Thank you so much, Mark, for having me.
Happy to have you on. It's your first time here. Really quickly, because it is your first time on the network, give our audience a little bit of an overview of your background. What did you do before becoming head of options over there at NYSE?
Yes, absolutely. So I originally started in the late 90s in San Francisco on the trading floor. So I was originally a market maker.
You're one of the early folks out there. You had to be up and going at like 6:30.
6:30, try 4 a.m.
Oh, yeah. Trading at like 6:30.
Yes,
To me, having the bell ring at 8, that was hard enough. But I never understood how you folks function. They'd always tell me, "Oh, but we get to be out by 1," and I was like, "Yeah, but you're asleep by 7. You live the life of a retiree." So
yes.
I could not have survived that. Well done.
In my 20s, it was a unique world for sure.
All your friends are out partying, and you're like, "I have to be in bed by 8."
Yes. And so after I was in the market making seat for quite some time, we moved over to becoming a specialist for Morgan Stanley, and then part of that, the world started going more electronic. Right. So in 2006, Morgan Stanley told myself and my partner at the time, who was my specialist, we had to go back to the main office. So we moved back to New York City, to Midtown. And at that point in time, there was an opportunity to go utilize my skill set and education in the option space on the electronic trading side. So I started moving over to a client-facing role, basically, under their electronic trading world, and helped develop their options algorithms. I moved over to B of A in 2008 and was at B of A for 11 years, and I moved to NYSE roughly almost 5 years ago.
Well, we always love seeing people in the head of options roles at the various exchanges who actually were market makers. It's good to come from the business, right?
Yes,
that's still
absolutely.
not a thing we see that often anymore, so it's good to see out there. We did poll our audience, Meaghan, before we came down here this week. We said, we're going to do our annual catch up with everybody down at OIC. What should we talk about? What is top of mind for you folks? We've been playing a fun little guessing game with all of our guests here. So now it's your turn, Meaghan. 2 issues really stood out above everything else for our audience and what they wanted us to talk about this week. Take a guess. What do you think they were?
I would imagine one would be adding daily options to single stocks.
Definitely the whole 0 day. You can lump it all under the rubric of 0 day, but that is definitely number 1, yes.
Okay. Number 2, I would say would be, I think it would probably be the quote traffic trends in the markets.
Almost. It's more, actually, it goes back to what you guys at NYSE kicked off last week with the whole 24-hour debate and polling. That deeply resonated with our audience as well. So they wanted that to be number 2, 24-hour trading. So we're going to hit all that fun and then a whole bunch more here. But we'll start with, as you correctly guessed, was the number 1 issue with our audience. They are obsessed with all things zero-day. Well, let's start there before we get into the weeds a little bit. These products are popular, but still contentious, even with our audience. When we poll our audience, they're usually 50-50 on whether they like these or think they're the worst things. They're about to ruin the options market. So at an industry event like this, people have differing views on these products. I'm curious, where do you fall on the whole zero-day phenomenon? Are you yay or nay? Are these, gamma bombs lurking out there in the weeds waiting to go off? Where do you fall?
So I would say that we've existed in a world where we've had zero-date options for a long, long time, forever, and that was the third Friday of every month. And then when weeklies came on board, they were on the Fridays for those products that have weeklies. And then in 2022, when the SEC got the approval for the original 3 ETFs to list zero DTE, we started adding additional maturities, right? That's our history. And as over time, we've seen, now being 2024, as you mentioned, a solid historical curve of volume and volatility and macro environment shifts and changes across the markets. But we haven't seen any negativity from adding in for these ETFs that are approved by the SEC. We know as of November of last year, 5 additional ETFs came to market where we have Wednesdays listed. And just to mention, and I'm sure maybe others have done the same for clarity purposes, these are listed 12 days in advance on each of our exchanges. So when, say, a new Wednesday comes up on a TLT underlying, you have basically the next 12 days to be able to trade that option. That final day of expiration, that Wednesday, is the final day to trade. But ultimately, we have a you have a long life cycle to be able to come into those. And on those ETFs, what we've seen essentially is definitely an improvement or increase in overall volume towards the last 2 days of trading. So it's very minimal, and then it just grows up very, very aggressively from a volume standpoint. But again, the market can be a great barometer of balance. If it was a negativity to the market, we wouldn't have seen the growth and continued stability in our markets. So we've been seeing a positive move.
And you are joining all your fellow exchange compatriots who have reminded me that they're not just zero-day, they are short-term options. So I think that genie is out of the bottle. I think they're just called zero-day forever now. But you're right, they are listed ahead of time out there. So it sounds like you're more on the favorable side then going forward. So you brought it up, the single name. Let's go there next then, because obviously our audience, they like these. Maybe some don't, but then they're like, what else you got? Well, what else can I trade? They want their Apples, their Teslas, their Nvidias. I've heard a lot of interesting things about what is gumming up the works and when we might see these or maybe might not see these. I'm curious, where do you fall on that as well? What do you think is the number one impediment to why we don't already have them? And then B, when do you think we may see these in the future?
Sure. So, all great questions. One of the things that is very important to us across the industry is to ensure that we have a broad-based level of support for large initiatives. And this topic in particular is a topic that we actually talk about at our listed options market working group, which is constructs of exchanges, market participants, as well as the SEC. So ensuring that we're looking ahead in the future of adding in possible dailies to single stocks is something that collectively, as an industry, we need to make sure we're doing the right things, right? So it is an active item, a very top-level item on that working group. We talked about it yesterday at our meeting here at OIC, and it's something that the industry needs to provide clarity to all sorts of processes. It's not just simply an exchange listings rule, which it has to be, but it has a tumbled impact across operation concerns, education to end clients, technology. There's a whole bunch of items that we need to make sure that we're holistically across the industry ready and prepared for, right? And we have to do that judiciously. So, having that as an item at the listed options working group is a very important area for it to be because that everybody's there, everybody can participate, they can share their views across, like I said, the spectrum of their seats. As an exchange operator, our view is our next step is one of the exchanges would need to actually create a rule filing and submit it to the SEC for approval for something like these, if and when we're ready, I think, across the industry. I think right now what we're seeing is let's all ensure that we know what the risks are by doing this. I think the second question you asked was what are the main concerns? I think the concerns is that unawareness of potentially that particular series is expiring that day by, say, a retail customer, and it happens to be on a volatility move where it's impacting the stock up or down in a way that they didn't expect, and they're holding their positions without exercising them or unwinding them to the following term structure. So those are typically the concerns, but I think as a whole, we as an industry whole have to make sure that we write out the pros and cons of ensuring a very consistent methodology and adding single stocks to dailies.
Yeah, that's interesting. So it sounds like you're on the later rather than sooner front in terms of when we might actually see these in the marketplace.
Yes, I think it's going to be on the later side.
Interesting, because I won't say who, but a colleague of yours from your exact same exchange group may have said exactly the opposite yesterday and said he thinks it will be months rather than years for some sort of, call it what you will, pilot or some sort of test program for that. So
yeah, I mean, everything we do has to go through the commission. So there is going to be a dialogue back and forth on what that will look like, and they will likely want to receive input from everybody to understand what that is. And that can be a lengthy process that we don't control, right? Even if we submitted that tomorrow and the industry was totally behind us, that does take, more than months' time.
I was surprised how optimistic he was, but hey, our listeners love it at the end of the day. They were happy about it. Speaking of our listeners, we also have institutions out there who listen and professionals. They're interested and or concerned about how zero-day is impacting the institutional landscape. You look at a product like SPX, and if you had told me 2 years ago that 50% of SPX would be trading and expiring on options that are listed that day, I would have said you were a crazy person, but that's where we are now. So clearly that's not just the grandmother from Iowa doing her 10 lots. That's big funds out there trading these too. As you've watched this volume evolve, how is that impacting the institutional space? How are they using these products? And also, have you noticed any change or evolution as a result of them maybe changing how they use options in light of the addition of these new products?
Sure. So you're asking from the institutional space, and the way we look at the institutional space is typically the breakdown of complexion of volume from the OCC data that we see. So how much is market maker, how much is customer, how much is firm? Those are the three constructs that we can actually accurately see in the data sets that we look at. Institutional falls in the customer grouping, of course, but also retail falls in that grouping too. So when we look at retail, we dissect it to say, of the order flow that we see, are they 10-lot contracts or less? We would consider to be retail volume. Anything greater would be, call it institutional in many ways, because it could be broken up algorithms that are sending in, multiple smaller pieces of a larger size order coming from an algorithm or a router. So, we see the customer component of these consistently be in the 20 to 25% range-ish of these new ETFs and SPYs, Qs, and IWMs. But SPYs and Qs, largely track, as you mentioned, the SPX side of things and the larger market on the single list prop side. For 40% of this SPY and Q's volume is on the short-dated options, which is pretty significant, more so than any other ETF. It's much smaller in the rest of them. So the institutions are using these as a tool because it's an additional tool in our sort of toolkit to be able to offer opportunity to be able to come into the market with a shorter time horizon. Maybe they use that as a part of a vertical or as part of a calendar spread to go to the following term. But we see that come through with like the same certainty that we see from the market maker side. We actually see more market maker to market maker volume in short dated, the ones that are currently listed, which we expect. Originally, when you see that, and back in my history, that would be a very toxic engagement.
Yes, that's not the kind of thing you wanted to see. Yeah,
people will run the other way. If I was previously when I was a market maker and I traded with other market makers, I would say, what did I get wrong?
Yeah, now your market is 3 times wider. Who's on the other side? Okay, now I'm much wider for him.
So my inputs are wrong, my volatility assessment's wrong, my interest rates are wrong, whatever may be the case. I thought maybe I would be getting something wrong, but because of the efficiency of the price within the spread, the market makers are actually coming in and coming out throughout the day in these and engaging with other market makers. And like I said, originally when I first saw this trend coming through the data sets, I was like, this isn't going to last long. At some point, this is a possible toxicity.
You think it can, right?
Right.
It should be limited flow.
But it continues to happen, and it continues in the breakout, because typically, as you know, in the option space, market makers are a very integral part of our markets. If we didn't have market makers, we wouldn't actually have a market, because they provide liquidity in every single series by providing quotes out there. And so over time, we're actually seeing it was very tightly coupled between customer to market maker volume. It was roughly 45 to 45% customer to market maker. Now it's like 52% market maker and like 44% customer. So it's we're eking out, and firm volume has shifted down a little bit. So that's like the last little bucket in the bottom. So we're definitely seeing more market maker to market maker transactions. I think they're finding edge in the series that are listed and available to trade, and it's been consistent in the data profiles that we see.
Well, you're surprising me here today, Meaghan. So that's always fun when someone can throw a new data point into the conversation. And speaking of throwing things into the conversation, we have you folks at NYSE to blame for the popularity of this next topic, which is, of course, the whole notion of should stocks trade 24 hours right now. We actually polled our own audience on this. We said, do you think stocks should trade 24 hours a day? And we have a very option-savvy audience out there. So you might be forgiven for thinking, oh, they want everything. They want it to trade all the time, and they want it all. But no, nearly 70%, 69.8% said no. They don't want stocks trading 24/7, which I thought was kind of interesting, and shows our audience they think through things beyond just the surface level. So that's why we're very thankful for them. But I'm curious, since you folks kicked it off, it's only right that I give you a chance to weigh in. Where do you fall on that debate in terms of should stocks trade 24 hours a day? And then B, for our vertical hair options, what impact do you think that will have? How will that play out in the options market?
Okay, so yeah, absolutely. So we have a research team within NYSE that conducts different components areas where we want to be able to focus when we see market drivers. So months ago, we actually were looking at short-dated options in general, and we actually did a survey on short-dated options we sent to our members in our community. So once we completed that piece of research and we published on our website, one of the next topics that our other parts of our teams were discussing was this 24/7 for equities. Should we have that? So our research team did another survey that had gone out to our members and our community, and that's where sort of got picked up by the news feeds of saying, well, okay, NYSE's behind it and we're going there tomorrow, and that's not the case. It is purely a survey that we were conducting across our members to make sure that as an exchange operator, we want to make sure that we're doing the right things, and we need to get people's inputs more broadly sometimes. And surveys are great tools to understand that component. It gives us another data element to really consider all of the impacts. We are hearing interest from Europe, LATAM, Asia, coming in from the equity space. Also hearing from similar geographical regions to have options have access in the earlier pre-market or the later evening for Asia. There's a lot operationally that would need to be considered across both asset classes to actually warrant that. So I think this is, similar to the conversation on single stocks adding in daily options. We need to make sure judiciously we're looking at these things across the industry the right way. We do have, on the equity side, some pre-market trading on some of our exchanges, on some of our equity exchanges. For options, we've heard a lot of interest to be able to at least make the European market side, so start earlier in the day. Once you cross the end of day close in the U.S. markets, there's a operational set of processes that always kicks off. Exercise and assignments, pricing at the OCC, where did your last sale trade occur? All of those things are very important parts of our ecosystem that operationally people tend not to be either A, aware of, or B, not really consider. So there is a litany of operational processes that would need to be considered and adjusted to be able to ensure that the clearing life cycle of options and equities is continued in a very stable manner. If we don't consider all of the items on the table to understand the clear roadmap to be able to get to that spot, we won't have a stable, resilient market to provide to our members, and nobody will Nobody will like that. So we want to make sure that we consider all the possible pieces and continue to provide a very scalable, resilient, stable market, transparent market.
In your view, then, if we do have some sort of augmented options market going for it, what is the optimal form that should take? Is it a limited test pilot maybe with the top 10 or 20 names? Is it maybe limited by time of the year, around earnings season, maybe not around earnings season, or just 24/7 have at it? What do you think is the optimal way to roll that out?
Yeah, I think it would be a small subset in a very targeted set of time ranges initially. So I think we would be absolutely, the right call would be to take baby steps into this, because there are so many processes and procedures that we would need to consider. Maybe many of the institutional types of clients would need to have additional support, possibly from other regions. What does that mean for reg purposes? What does that mean for cost purposes and technology? What does that mean for market makers providing liquidity during those periods of time? Typically, there are early trading hours on a subset of products on another exchange, and liquidity is number one concern in that space. But also handling balance sheet and understanding how much does it cost to be able to provide those quotes out in the markets is absolutely something that needs to be considered in this process. So, yes, I think we should be looking at this in a very baby step type of manner.
Another trend we've been talking about a lot here at the conference, and certainly for the last pretty much 4 years since the onset of the pandemic, has been this near exponential growth rate we've seen in the options market. Volume-wise, it's been explosive. We see it anecdotally here on our network, just the number of people coming in, discovering options on a weekly and monthly basis. It's been phenomenal to see. And the question has been, can this continue? And early on, I like many people, former market maker, I think I have a skepticism bred into me. So I thought this is a near-term aberration. People are home now, but they're going to go back to work. Trading won't be the only game in town anymore, and people will do other things, and it'll fall back to where we've known it for years. And that hasn't happened. I was proven wrong, happy to be proven wrong. And so now I've had my skepticism bred out of me. It could go wherever the winds of fortune take it. Of course, last month, the winds of fortune blew it down a little bit. We were down, I think, roughly 10% in overall volume. Again, it's not quite apples to apples, because last March was, of course, contagion time. So a bit of an outlier from a data perspective, but still one of the first down months we've seen in a while. So people are obviously asking the question again now, does this mean we're plateauing? Is volume coming back down the other way? Is this just the pause before the next up leg? So you obviously see a lot of volume data over there at NYSE. What are you seeing? What kind of trends are you noticing? Your thoughts about last month, and what does that portend for the future here in the options volume front?
Sure. So a lot to unpack in that, right? There are many drivers. The macro environment, for sure, is a component of that. With high rates that continue to come out, we're still seeing very strong earnings growth from companies that are coming through the earnings cycles, right? And which drives oftentimes volatility in the markets, which drive options volume and equity volume comparatively. So, we're having. I believe that we're seeing continued growth in the U.S. options market in the volume space. I think we're seeing that coming through, and we talked about this a little bit in the panel yesterday, from the growth of options embedded into certain ETPs that have been coming out. We've seen a year-over-year growth of 3x the number of ETPs that are available to trade that have some level of option Greeks associated with them in part of their profile. That means options market volume is a component within the ETP itself. So therefore, they're investing in our options markets. So that continues to grow. The assets under management have skyrocketed to over $100 billion from just under $25 billion about a year ago, or even 9 months ago. So the money is definitely moving over towards that space, and so we have additional liquidity coming in from that part of the markets. We also have a couple things on the table, right? We have the election coming up this year. Typically, that has a stronger market background, but may not continue to stay so strong. But we still think that this year will still stay like a positive return market. We also have a couple products that are in the pipelines that are being discussed around Bitcoin options, and that if and when that would be considered to be added to the U.S. options markets, pending the commissions and the OCC side, support side, really depends. That could be another momentum of new volume that would be coming to our markets. That would be a big driver. And so there's a lot of things in the pipeline that are currently occurring that we think are going to be increasing and growing. We also think that there are some things out there that may be coming in. I would say the single stock dailies, it's not an if, it's definitely going to be a when. And so the question is, to your point, is like, is it months away or years away? We don't know. But I would say when that comes, that will also drive volume to our markets. So we see a strong curve and a lot of interest coming from the other geographic regions, LATAM, Europe, and Asia, coming in. And a lot of times that comes into us as a connection or introducing broker kind of relationship, because they're not U.S. broker-dealers, so they cannot connect directly to our exchanges until they get to that spot of growth cycles within their own firms. And some are. There are moving, coming in from European-based firms coming in. So we see a lot of positivity pointing to increased continued growth. Is it going to be 20%? No, probably not. I think it's still going to be coming up in like that 5 to 10% range, maybe 5 to 7. Over year-over-year growth, because we do have a solid pipeline, I think, of interesting things. And it's exciting in being in the business as long as we have. And I've seen a ton of different styles of markets that have impacted the option side. But it's exciting. This is a great time to be in the U.S. option space.
Speaking of exciting, you mentioned the other thing that people wrote in quite a bit on our polls and are excited about are the Bitcoin options and the options on the ETFs, I should say. I've heard different viewpoints on whether those are coming, or if the question there might seem like it might even be more of an if rather than a when. I'm curious, what are you hearing? What are your thoughts on? Sounds like you think we will see them, but what are your thoughts on, is it a when or is it even still an if?
So from the exchange side of things, it is out for public notice and comment. We actually have 3 filings with the SEC on being able to list them. We had it at the commodity level. We had it at the asset class level of Bitcoin ETFs in general. And then we have per product level. So those are all with the commission, and they're all open for comment. And we definitely always encourage our members and our communities that are looking to trade them to publicly comment. So I encourage all your listeners to, if they feel they want to trade them, to comment.
Watch out, you're opening the floodgates. They will comment in mass.
And so that from an exchange standpoint, that's where we stand, right? The other part of it is that we also are working with the OCC, as well as the other exchanges I know are as well, to see if they'll be able to clear them. And so the OCC is going through their process of considering this as a tradable instrument to clear. So we would need both to come back and say, yes, you're approved, and OCC will clear them for us to be able to go through our normal strike listing process on the exchange side to list them in the markets for the investors to trade. I think we're trying. I think we feel like there's great opportunity with this, and we think that's going to be an opportunity for investors to be able to come into the market and have a level of crypto engagement in a U.S. regulated market.
You think it's fair to say not in 2024 probably is likely?
I think probably not in 2024 is probably right, yeah. But maybe a 2025 item.
Don't get mad at me, listeners. That's all you wrote in for Bitcoin options. Yeah, it just sounds like, unfortunately, that is the scuttlebutt we are hearing out here. Well, I appreciate you joining us today here, Meaghan. Before we go, I know exchanges are always working on interesting new things behind the scenes. Maybe leave our audience with a little bit of a hint, a little bit of a tease of what you have up your sleeve that may intrigue them, what they can look forward to coming down the pike from NYSE in the coming months.
Yeah, thank you. So we just completed our last migration over to our new technology, our technology system called Pillar. So now all of our equity markets and options markets are on the same single code base, which really helps us scale, and our members have very clear determination of how they engage with NYSE. So that is very beneficial across the trading, technology, and operational support side. Now that's in our hindsights, and we've seen improvement in overall latency. We've reduced our latencies on our options markets by 2/3 from our previous system, and that's shown itself in overall share. So on Amex, our share has increased roughly 150 basis points since October, and we definitely attribute that to our performance on our technology side. Technology never stops or sleeps. We continue to improve. We have a couple of optimizations coming in May to help reduce some of our tail latencies, and then also provide some market maker quote benefits as well to our trading community. But what I'm looking forward to in the end of 2024, we're focusing on a couple of initiatives around flex options. make them more electronically supported.
You're not the first to bring up Flex to me today. Seems like everyone is en masse moving towards Flex. Why is Flex exciting for NYSE right now?
Sure. So we've seen just year-over-year growth of Flex volume by 60%. So overall Flex volume that you can see at the OCC level from a data set is improved greatly, and even from 2022 levels. So the market continues to grow, and that's really a conduit and component coming from those ETPs with embedded options that are a component of them. They are trading Flex options, so therefore the Flex market is going up. So you'll see a lot of that improvement coming from those. So the more of the rise of the ETPs that have options, embedded strategies within them, really the output is Flex traded volume. Amex and Arca, our two exchanges, support Flexes today, and we are now, in April, I'm happy to say, the number one exchange by volume in Flex volume right now. That area, it is a flexible instrument, so it doesn't have the same exact constructs as everything that's listed, but we can make the input of them more systematic. So we're working on that, and if we want to be able to, we ultimately, with the SEC side approval later this year, we hope to be able to provide an electronic Flex mechanism in our price improvement auction called Cube.
You're the first person to come on here and actually explain where all this Flex flow. I've been hearing so much about this Flex flow. That makes sense, though. The ETPs with the embedded option out, that would make sense that they would probably need a little bit more custom solution out there, which is faster. Yeah. Well, Meaghan, I appreciate you taking some time out to discuss these topics with our audience, and we'll look forward to seeing how all this, including the Flex, how it all plays out in the marketplace in the coming months.
Thank you so much, Mark.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.